What if I told you that 90% of traders are reading charts the wrong way and it's costing them money every single day? The missing piece, market structure. In this video, we're breaking down the single most important concept in smart money concepts trading. Once you understand market structure, everything, your entries, your exits, your bias, clicks into place. I'm talking about the exact framework professional traders use to track institutional money. Let's get into it. So, what is market structure? Simply put, it's the framework of swing highs and swing lows that price creates as it moves through the market. Think of it like footprints. Every time price makes a significant move, it leaves a structural point behind. Connect those points, and you can literally see where institutional money is flowing. Now, here's what market structure actually tells you. And pay attention because this is gold. One, the trend direction. Is the market pushing up, down, or ranging? Two, the trend strength. Is structure clean and consistent or messy and choppy? Three, the key levels. Where are the critical structural points? And four, when things are changing. When is the trend potentially reversing? Markets don't move in straight lines, they move in waves, push up, pull back, push up, pull back. Each push creates what we call a swing point, either a swing high or a swing low. A swing high is a peak in price with lower highs on both sides. A swing low is a trough in price with higher lows on both sides. And here's the key, not every high or low counts. A valid swing needs to clearly stand out on your chart. The bigger the time frame, the more significant the swing. All right, let's talk about bullish market structure. A market is bullish when price consistently makes higher highs and higher lows. That's it. Simple rule, massive impact. Visually, it looks like a staircase climbing upward. Each peak is higher than the last. Each trough is higher than the last. Let me walk you through a real example. EURUSD is sitting at 1.0800. Price rallies to 1.0850. That's our first swing high. It pulls back to 1.0820. Then it rallies again, this time to 1.0880. That's a higher high. It pulls back to 1.0845. That's a higher low. Then it pushes up to 1.0920, another higher high, pulls back to 1.0870, another higher low. That's clean bullish structure. Institutions are buying. The trend is up. Now, what does this tell you as a trader? One, only look for long trades. Don't fight institutional direction. Two, buy at the higher lows, not at the highs. That's where smart money re-enters. Three, your stop loss goes below the last higher low. If price breaks it, structure is broken. And here's the most expensive mistake retail traders make in bullish structure. They see a small pullback and immediately think, this is the top, time to short. Wrong. In strong bullish structure, pullbacks are buying opportunities, not reversal signals. Institutions are loading up while retail traders are shorting. Then price explodes higher, shorts get wiped, and the staircase continues. Don't fight the structure. Now let's flip it. Bearish market structure. A market is bearish when it consistently makes lower highs and lower lows. Another staircase, but this one goes down. Here's the example. EURUSD starts at 1.1000. Price drops to 1.0950. Swing low. Bounces to 1.0980. Swing high, already lower than where we started. Drops again to 1.0920. That's a lower low. Bounces to 1.0955. That's a lower high. Drops to 1.0880. Another lower low. Bounces to 1.0920, another lower high. That's clean bearish structure. Institutions are selling. Don't try to be the hero who calls the bottom. In bearish structure, only look for short opportunities. Wait for the bounces to lower highs, look for bearish signals there, and target the next lower low. Now, here's the bearish version of that expensive retail mistake. It's fallen so much that it must bounce now. That's the buy the dip trap, and institutions love it. Why? Because they need someone to sell their short positions to. Retail traders buy the dip at a lower high, which is exactly where institutions are unloading more shorts. Price then drops to a new lower low. Buyers get stopped out, and the cascade continues. And here's something important to understand about bearish moves. They tend to be faster and more violent than bullish moves. As price drops, stop losses trigger, which creates more sell orders, which drives price lower. It's a cascade effect. Respect it. Here's a concept that separates retail traders from professionals, the difference between trend and structure. Most traders treat these as the same thing. They are not. Trend is the general direction of price. It tells you which way price has been moving. Structure is the specific pattern of highs and lows. It tells you where exactly you are in that move and when it's about to change. Here's an analogy. Trend is knowing you're driving north. Structure is your GPS, telling you exactly where you are on that road, where the turns are, and when you need to recalculate the route. Now imagine two charts. Both have a bullish trend. Price went up on both. Chart A has clean higher highs and higher lows, clear pullback levels, easy to trade. Chart B, same direction overall, but it's a mess. No clear structural points, no predictable entries. Both have bullish trends. Only one is tradable. And here's the most important rule when the two conflict. Trust structure over trend. Why? Because structure changes before trend does. Structure is the early warning system. If EURUSD has been in a bullish trend for weeks, but on the 4-hour chart, you're suddenly seeing lower highs and lower lows forming. That structure break is telling you something the trend hasn't confirmed yet. The traders who ignore it get trapped. The traders who respect it get out early and flip their bias. All right, let's make this practical. Here's your exact step-by-step process for identifying structure on any chart. Step 1, choose your time frame. Daily for swing traders, 4-hour for day and swing traders, 1 hour for intraday. Step 2, mark your swing highs. Look left and find the significant peaks, not every tiny wiggle, the ones that stand out. Mark the last 3 to 5. Step 3, mark your swing lows. Same thing, identify the troughs that clearly stand out. Mark the last 3 to 5. Step 4, compare sequential highs. Is each high higher or lower than the one before it? Rising highs suggest bullish structure. Falling highs suggest bearish. Step 5, compare sequential lows. Rising lows confirm bullish. Falling lows confirm bearish. Step 6, confirm the pattern. You need at least 2 to 3 complete swings before committing. 1, higher high doesn't confirm bullish structure. You need higher high, minimum. Step 7, draw your structure lines. Connect the highs with a line. Connect the lows with a line. Bullish structure, both lines slope upward. Bearish, both slope down. Now, 3 common mistakes to avoid. Mistake 1, marking every tiny wiggle as a swing point. Zoom out. If it disappears, it's not significant. Mistake 2, mixing time frames. Don't combine a daily swing high with a 1-hour swing low. Keep it consistent. Mistake 3, forcing structure. Not every chart has clean structure. If it's messy, no trade is the right trade. Seriously, this discipline alone will save you from so many bad entries. Here's how this works in real time. Let's say EURUSD is in bullish structure Monday morning at 1.0900. Clear higher highs and higher lows confirmed. By Monday afternoon, price pulls back to 1.0860, testing the previous higher low at 1.0870. This is a decision point you're watching closely. By Monday close, price has closed at 1.0850, below that higher low. That's it. Bullish structure is broken. You don't hope, you don't hold on to longs, you update your analysis immediately. Now you're watching for bearish structure to form. A new lower high would be the first signal. A new lower low confirms it. This real-time tracking is what keeps you on the right side of institutional moves, not chasing them after it's too late. Let's recap what you now know. Market structure is the framework of swing highs and swing lows that reveals institutional direction. Bullish structure, higher highs and higher lows. Trade longs at the higher lows. Bearish structure, lower highs and lower lows. Trade shorts at the lower highs. Structure is more actionable than trend. It changes first, giving you advance warning. Clean structure is tradable. Messy structure is not. And when in doubt, trust structure over trend. In the next module, we're going deep on break of structure and change of character, the exact moments when institutional direction shifts. These are arguably the most powerful signals in all of SMC trading. If you found this valuable, hit like, subscribe, and drop a comment. Let me know which part of market structure you found most useful. I'll see you in Module 5.